Now let us discuss the money market instruments in detail, which includes treasury bills, CDs or certificate of deposits, commercial papers which are exchange traded, repurchase agreements, bankers' acceptance, and interbank money. Now these are a list of money market instruments, out of which T-bills, CDs, CPs, they are all exchange traded money market instruments, whereas repurchase agreements, bankers' acceptance, interbank are all over-the-counter trades. Let us discuss each of these money market instruments in detail. To start off with, we will discuss the treasury bills or the T-bills first. The T-bills are one of the safest money market instruments as they are issued by the central government. They are zero-risk instruments which are circulated both in the primary and the secondary markets. Maturities of these T-bills are normally 3 months, 6 months or 1 year. As we know, it cannot be more than 1 year as it is a money market instrument. And they are issued through auctions and named as a 91-day T-bill or a 182-day T-bill or 364-day T-bills by the government. These T-bills are normally issued at a discount which is priced less than the face value, and the difference between the buying price and the maturity value is the interest earned by the holder of the instrument, something which we just discussed in a zero coupon instrument. T-bills are normally issued in multiples of rupees 25,000 or more. Now let us talk of CDs or certificate of deposits, which are like negotiable unsecured promissory note, which is issued by a bank in the form of certificate entitling the bearer to receive interest. It is similar to a bank term deposit, and these certificate bears the maturity date, fixed rate of interest, the nature of interest at which it is issued, etc. As we can see in this diagram, all the details regarding the loan is specified on this certificate of deposit. The CDs are again issued in multiples of rupees 1 lakh and more. Maturities for these CDs for banks should not be less than 7 days and more than 1 year. For financial institutions, the maturity can be from 1 day to 1 year to 3 years. The rate of return normally which we see you earn on a CD are higher than that of T-bills because they carry a greater level of risk compared to a T-bill. Coming to the next category of money market instrument, which is the commercial paper. Now CPs are short-term unsecured promissory note which is issued by corporates or other financial institutions, which is normally issued at a discounted value or face value. Unlike CDs, CDs were issued by the government, and CPs are unsecured promissory note which is issued by the corporates. Now, these topics are quite important from the examination point of view, as we might face a lot of questions, short questions from this segment. These are normally, CPs are normally issued by the corporates for the purpose of financing of accounts receivable, working capital, short-term liability, to pay off their short-term liabilities, etc. They are issued of rupee 5 lakh or more. And the returns of CPs is normally higher than T-bills because again they are unsecured and they carry a higher level of risk. They have maturities normally for 7 days to 1 year. And again, rate of return is higher than the T-bills. Coming to the next category of money market instrument is the repurchase agreement. Repo or reverse repo is a secured money market product where borrowing or lending for a period for 1 year or less happens. Mostly the trades in a repurchase agreements are for overnight to 1 week, and they are secured lending against a collateral. That means to enter into a repurchase agreement, you need to giving your collateral basically like a mortgage or selling a collateral in exchange of a loan. As we had discussed earlier, that these repurchase agreements are over-the-counter trades. They are not exchange traded. This repurchase agreement makes it different from any other loan against collateral because the collateral which is used for these repurchase agreements has to be actively traded. It has to be extremely liquid and should not be very volatile from the price point of view. So normally the collateral which is used for these repo transactions are T-bills or sovereign bonds. Normally these repo trades are structured as buy or sell trades. That is, simultaneously you sell and repurchase the collateral security with different settlement dates. Now, how do they work? The cash borrower gives the security, rather a T-bill, and takes cash in turn in the first leg of the agreement, which is structured as a sell trade for the borrower. And there is a second leg, the repayment of the loan, and it is structured as the repurchase or the repo trade for the cash borrower. As we can also see in this diagram, that first the seller sells a government security as a collateral and it receives cash from the lender of the money, and at the maturity the seller repays back the cash fund which he had borrowed inclusive of interest, and the lender returns back the government security or the T-bill sovereign bond to the seller, which was used as a collateral for entering into a repurchase agreement. Coming to the interbank money market, here both the lender and the borrower are banks, and the borrowing is on a clean basis. As the name is suggesting, it is an interbank money market. The period of borrowing is for standard tenures, which are normally either overnight or a week, 2 week, 1 year, or at monthly basis. The overnight borrowing is extremely liquid and most important in the interbank money market. If the rate of interest remains high in the interbank money market, it is an indication that there is a shortage of money in the economy, and on the vice versa, if the rate is low, it indicates surplus money in the economy. Now, let us have a look at the classification of bond markets. Just to revise quickly, bond markets are those fixed income securities which has a maturity of more than 1 year. Bond markets can be classified on the basis of issuer, interest rate, and the credit quality. Now, Under the issuer category, we can have sovereign bonds, which is issued by the government, and we can have corporate bonds, which is issued by the corporate bodies. When we talk of interest rate, in the bond markets, we can have again three categories. One is the fixed rate of interest, which is periodic coupon and is known in advance, which is going to be received by the lender. Then we have a floater rate instruments, wherein the interest rate varies periodically and is proportional to the market interest rate. Last but not the least, there is the inverse floater, which pays coupon linked to the market interest rate but links it inversely proportional to it. One of the most important classification of bond market is the credit quality. It makes a lot of importance that what rating the particular bond has got through different rating agencies. So according to the credit quality, we can have a rating by S&P, which operates through CRISIL in India, and Moody's, which operates in India through ICRA, and Fitch. So rating by these agencies play a very important role in evaluating a bond market. So we have derivative instrument based on these different class of securities. We can quickly have a look at what are the different ratings of different organizations. As we can see, that a rating of AAA by these rating agencies as S&P, Moody's and Fitch implies that the underlying bond is extremely strong in fundamentals. It is having very strong fundamentals. Or a AA plus, AA1 or AA plus, or all these A's are basically implying that the bond, underlying bond, has very strong fundamentals. On the contrary, if we have a look at these B's by these rating agencies, it shows that the fundamentals are adequate, but it is more susceptible to adverse changes in economic conditions. They are normally speculative in nature, and hence they are more risky. And a rating of C's, triple C, double C, C, double A, like that, these imply that these underlying bonds are speculative and currently very vulnerable and risky. And of course, a rating of D will implies that default in that particular bond has already occurred. So this was a very small brief on the bond markets or the fixed income securities market. Now let me just show you how you can actually prepare these exams through eLearn Markets. We on eLearn Markets are actually offering many courses, which includes a series of NISM courses also. So if you log on to eLearn Markets, you will have a look at this page, and if you click on the courses, and under courses, if you go to NISM, a series of NISM courses which we offer can be seen. Now this NISM courses has been designed in such a way wherein the tutorial videos have been recorded in such a way that it helps you clear the exam. More emphasis has been given from the examination point of view, as in what are the different questions which you might see in the exam, etc. As you can see here, right now currently we have these 4 preparatory exams, which includes NISM Series 1 currency derivatives. Then we have the NISM Series 8, which is the equity derivatives. We have the NISM Series 13, which is the Common Derivative Exam, Inclusive, which is basically a combination of 1, 8 and 4. And then we also have NISM Series 5B, which is a Mutual Fund Foundation Certificate Examination, which is important again for any person who is seeking to become a mutual fund advisor or distributor. Now we enter into the course, we can see if we have a look over here in the course content, a chapter-wise basic tutorial, a chapter-wise tutorial has been prepared, and like the first chapter that we had seen in the PPT, which consists of 4% wage, 3 videos have been recorded for that. And then we have, at the end of each chapter, we have a preparatory set of questions under each chapter, that what are the different types of questions which we may see in the examination from this particular chapter. So as we go down here, we can see that from the introduction to the underlying markets, we have these videos explaining the entire chapter, and then again we have a set of preparatory questions which would, if we prepare them, which would help us clear the exam and also to approach any kind of questions which we may see from this exam, from this chapter. So likewise, all these chapters are there: accounting and taxation, sales and practices, legal and regulatory environment, introduction to trading, clearing and settlement, option and strategies, etc. Also, we have a test tab over here, in which we have 2 full-length common derivative mock tests. So each test over here is consisting of 150 questions, and for which a time duration of 3 hours would be given. So after completing the entire course under this course content, you must take these mock tests, which gives you a feel of the real examination, as if you are giving a real NISM exam, and it helps you prepare the exam and clear it. Most importantly, clear it. So this is 2 full mock test, full-length mock test exams which we offer along with this course. So this is all about it. In case you all have any questions, you all can come up. Any questions you may ask me. In case you have any questions regarding to this subject or this topic, you can ask me. Okay, any questions? So thank you everybody. With this, we end the discussion of the NISM preparatory exams. Thank you.